Welcome back to Alpha Recap, your quick, smart wrap of today's market movers. We're closing out the trading day with some interesting beats, big tech Capex, and a high-profile warning that shook the tone a bit. As always, if you have questions, you can reach us at stockalpha.ai.
Hey, great to be here. Big day. Corporate results that surprised, and a reminder that price still matters. So, where do you want to kick off?
Let's start with the beat and raise theme. That was the headline for a lot of names today. GM snapped a four-quarter top-line decline.
Right. And the number that really caught people's eye was GM's quarterly revenue came in at about $48 billion, up roughly 2% year over year, and adjusted earnings per share were about $3.57.
That was enough for them to nudge guidance higher, which, when you step back and look at this, can change dealer inventory and free cash flow conversations pretty fast.
Yeah, absolutely. The market treated it like a classic cyclical snapback. The real question is sustainability. Was this a one-quarter demand bounce or the start of a deeper recovery in North America and China?
Good point. Follow the order books, incentive trends, electric vehicle margins, and financing spreads.
Next up, industrials. 3M posted adjusted second quarter sales of about $6.5 billion and actually raised full-year guidance.
And that was another beat and raise moment. Analysts are telling us margin repair and guidance matter more than headline gap noise for 3M.
Exactly. Look at operating cash flow, working capital trends, and the old litigation reserve story. Those swing the real value.
So, beats in autos and industrials. But the most talked about number of the day was tech Capex. Alphabet signaled record cash commitments into data centers ahead of its report.
Capital spending taking center stage. The debate is whether Capex is optionality or an execution risk. Investors want to see monetization per server and revenue tied to AI services, not just the raw dollars deployed.
Right, and the market is pricing optionality into names like Amazon, too. One analysis flagged about a 24.5% premium in Amazon's relative valuation discussion. So people are paying for future optionality,
which is a bet on future monetization. If that optionality pans out, higher revenue per rack, better AI margins, then the premium has a story. If not, that premium can get ugly.
And then there was the counterpoint to the rally. Jamie Dimon said he wouldn't be buying equities or treasuries at current prices. That comment injected a note of caution into the tape.
Yeah, big voice, big effect. Analysts framed it as a reminder that markets might be underestimating certain risks, macro, credit, or valuation related.
So we have a tug of war. Earnings momentum in pockets versus valuation caution from prominent market leaders. That's basically the theme today.
And it played out across sectors. Tech and AI-exposed names showed margin expansion and revenue beats in some cases, while biotech and small caps were all over the place.
Guardant Health got positive attention, while GeneDx missed on revenue and sold off. It's a reminder that dispersion is alive and well.
Not a great day for some of those small caps.
Short reactions here. Big move in regional banking performance.
TFS Financial rallied to about $18.30 after a strong 6-month run of roughly 26% total return.
Nicolette Bank shares has been a standout over the long run, up about 136% over 5 years and trading around $167.35. Those runs change how people size positions.
Right. Higher past returns mean you rethink concentration, check deposit trends, and watch net interest margins closely.
And there were some puzzling disconnects. Progressive delivered better earnings, but the stock didn't follow, trading near $207.95, while EPS strength barely moved the price.
That's where value or contrarian investors start digging. Underwriting, loss ratios, and whether the market is already looking through the numbers.
Quick segment. Single lines only.
Salesforce fell about 4% to roughly $164.15.
Hold on, say that again?
Salesforce slid after an analyst argued its AI transition might be lagging.
Execution now equals valuation in tech. If your AI roadmap slips, the market notices.
Totally. That's why Capex efficiency matters. Big spending without clear monetization proves painful.
Let's pull this into what it means for different investor types.
Growth and AI-leaning investors basically saw encouraging signals, earnings momentum, and some margin expansion. but they need to watch execution metrics and Capex efficiency closely.
Income and dividend-oriented folks got a few positive signs, stabilizing auto cash flows and improving industrial results. But litigation and leverage still matter for payout sustainability.
Value or contrarian investors have things to research, the disconnects like progressives. But you need to dig into underwriting and structural changes before calling it a bargain.
And bank watchers, those regional rallies change how you size positions. With large run-ups, focus on credit quality, deposit stability, and capital metrics, not just momentum.
Risk-averse investors heard Diamond and probably felt encouraged to check hedges and liquidity cushions. The headline calm can mask vulnerabilities.
Let's break down the strategic checklist for people who want to follow the tape without getting whipsawed.
First, read past the headline numbers in earnings prints. Capex efficiency, revenue per user or per server, and cash flow conversion are the real signals for Capex-heavy names.
Second, track dispersion. Aggregate strength doesn't stop company-specific shocks. Biotech and small caps will keep moving independently.
Third, reconcile valuation signals with fundamentals. If something is trading at a premium, like the Amazon example we mentioned, confirm the optionality assumptions are realistic.
Fourth, in financials, watch net interest margin trends, deposit flows, and credit performance. Strong share price runs change risk sizing and monitoring.
And finally, keep macro and geopolitical scenarios in your toolbox. High-profile caution is a prompt for stress testing, not panic selling.
Quick reactions, under 10 words.
Earnings help the bull case, but it's selective.
Capex is a headline. Monetization is the test.
Diamond's caution matters for allocation conversations.
Before we wrap, a few deeper notes on Alphabet specifically.
Alphabet's spending is a strategic bet on AI. The important numbers won't be Capex alone. There'll be incremental revenue per server, AI service margins, and enterprise cloud traction.
So investors will watch commentary about monetization velocity for generative AI services when Alphabet reports, because Capex has to turn into profit leverage.
And that's really the lesson across tech. Spending is only as good as conversion into monetization and margins.
All right, time to pull this together. Key takeaways?
1. Earnings momentum is real but uneven. Some companies beat and raised, and that gave the tape lift in pockets.
2. Capex is now central to valuation debates. It's not the amount spent, but the efficiency of that spend.
3. Valuation caution sits alongside conviction trades. High-profile voices reminded the market to price risk carefully.
4. Dispersion matters. Biotech and small caps can diverge from the broader trend, so expect cross-sectional volatility.
5. Tailor the signal to your investor type. Growth investors track AI monetization. Income investors watch cash flow and liabilities. Bank watchers focus on credit and deposits.
Final reminder, this discussion is informational only. Analysts note trends and metrics. It's not a recommendation to buy, sell, or hold any security and isn't personalized investment advice.
If you want to dig deeper or have a question about anything we covered today, head to stockalpha.ai, where you can ask us directly and we'll answer live. For more market analysis and insights, visit stockalpha.ai.
Thanks for joining us on Alpha Recap. We'll be back after the next session of earnings and data to walk you through what changed and why it matters. See you next time, and remember, ask your questions at stockalpha.ai.